about the treatment of goodwill if it already appears in the books. Now you know that goodwill is an asset and it appears in the asset side of the balance sheet, and when an admission takes place, what will happen to that goodwill we'll talk in this video. We are given a case over here where we have three partners A, B and C with a profit sharing ratio of 3:2:1, and on the date of admission of D, the new PSR becomes equal and there is a goodwill in the balance sheet worth 60,000. Now there is no other information about goodwill being brought in by the new partner or capital being brought in by the new partner, which is not required actually over here, and not that new profit sharing ratio is also not required. Always remember, whenever admission takes place or whenever retirement also takes place, which we'll do later, that whatever amount of goodwill is appearing in the books will be distributed among old partners in the old profit sharing ratio, and since goodwill is an asset, goodwill will be credited and the capital accounts of the partners will be debited. So let us see what will happen over here, and you can see very carefully that we had three partners A, B and C, and therefore the journal entry will be A's capital account debit, B's capital account debit, C's capital account debit to goodwill. Now over here, please see the amount. The goodwill amount is 60,000, and if it has to be written in the ratio of 3:2:1, which is the old profit sharing ratio, first partner will get 30,000, second partner will get 20,000, and the last partner will get 10,000. So A will get 30,000, B will get 20,000, and C will get 10,000. So this will be the treatment of goodwill appearing in the books on case of admission. Now we have taken the same sum, but we have added one more condition over here. Please see very carefully. The PSR of A, B and C, as in the previous case, was 3:2:1, and D has come in for 1/5 share, and the goodwill in the books is 30,000, and D also brings a goodwill of 60,000. Now when the new partner comes for a specific portion or a specific percentage, we don't have to calculate the sacrificing ratio. I have explained that many a time, so therefore we will not need to calculate the sacrificing ratio over here, because the new partner has come in for a specific percentage or specific share. Here he has come for 1/5 share. Now there will be two treatments of the goodwill. Number one, the goodwill which has been brought in by the partner, and second, the goodwill which appears in the balance sheet. Now the goodwill which appears in the balance sheet, that is 30,000, will be distributed in the old profit sharing ratio 3:2:1, and the goodwill which has been brought in by the new partner will have two entries. First entry will be the cash account debit to premium for goodwill, and then premium for goodwill to the sacrificing partner's capital account. So let us get started and do the journal entries. In this case, the first journal entry, you can see very carefully, the journal entry will be A's capital account debit, B's capital account debit, C's capital account debit to goodwill. Please see very carefully. I have not used the word premium for goodwill over here, because this goodwill is appearing in the books and it is to goodwill. And what is the amount? You can see over here 30,000. And if you write 30,000, the ratio of 3:2:1, 30,000 divided by 6 gives us 5,000. So the first partner A will get 15,000, second partner 10,000, the last partner will get 5,000. So this is the first treatment of the goodwill which appears in the books. The second information which has been given, the new partner has brought in 60,000 as goodwill. So the first journal entry for bringing the goodwill, that will be bank account debit to premium for goodwill, bank account debit to premium for goodwill, and the amount over here is 60,000. You can very clearly see that the new partner has brought in 60,000, and since the new partner has come in for a specific share, all the three old partners have actually sacrificed in their old profit sharing ratio, which is 3:2:1, and which will be the next journal entry. That will be the distribution of goodwill among the sacrificing partners in the sacrificing ratio, which happens to be the old ratio in this case. Therefore, the journal entry is premium for Goodwill account debit 60,000 to A's capital account to B's capital account to C's capital account. So what is the amount? See very carefully. It will be 30,000 to the first partner, 20,000 to the second partner, and 10,000 to the third partner, because the sacrificing ratio is equal to the old profit sharing ratio, 3:2:1. Now, let us take another case in which we are seeing that it is a different case in which the new partner is bringing goodwill partially and there is already a goodwill appearing in the books. If you read the question very carefully, we can see over here X and Y are two partners with a profit sharing ratio of 3:2, and they have taken Z as a new partner, and then the new profit sharing has become 2:1:1, which is written at the last line. And you can see that the new partner Z has actually brought in 40,000 of his share of 60,000 as the goodwill. So please understand this very carefully. The new partner was supposed to bring in 60,000 as the goodwill, but he has only brought in 40,000 over here, and there is a goodwill which is appearing in the books as 50,000. So the goodwill which appears in the books will be distributed among old partners in the old ratio, and the goodwill which is brought in by the new partner will be distributed in the sacrificing ratio. Here, since we have a old ratio and the new ratio given, the step becomes very clear. Number one, we need to calculate the sacrificing ratio, and then only we can go ahead with the journal entries. So let us start with the calculation of sacrificing ratio and then go ahead with the journal entries. So first, we know that sacrificing ratio is old ratio minus new ratio, and you can see over here X had an old ratio of 3/5 and X's new ratio is 2/5. Very simple calculation, 1/5. And for Y, the old ratio was 2/5 and the new ratio is 1/5. The sacrificing ratio will be 1/5. Therefore, sacrificing ratio is 1:1, which means equal. Now you can see that a goodwill is appearing in the books as 50,000. So that is the first thing which is a concern. That is the first thing which will be taken by the partners who are the old partners over here. It is X and Y. Therefore, we'll do the journal entry first. That's X's capital account debit, Y's capital account debit to goodwill appearing in the books, and the amount is 50,000, and 50,000 will be written in what ratio? It will be written in the old profit sharing ratio 3:2. Therefore, X will have 30,000 and Y will have 20,000. This is the first treatment. The second treatment, you can see over here, goodwill of the new partner is 60,000, but he is able to bring only 40,000. We can pass two separate journal entries, or we can pass just one journal entry. I'll show it by passing one compound journal entry of that. Now you can see over here the goodwill who has brought, how much has brought in 40,000. So therefore, that journal entry will be bank account debit to premium for goodwill. How much has been brought in? Please see very carefully. The amount has been brought in 40,000 out of the share of 60,000. This is the treatment when the money has been brought in. Now, we also know that 20,000 has not been brought in. How did I get 20,000? 60,000 minus 40,000, 20,000 has not been brought in. And now I'll show that by passing one journal entry. I can pass two separate journal entries. I can pass this journal entry for premium for goodwill for X's capital account, Y's capital account, and show the effect of 40,000, that is 20,000, 20,000. Or I can merge the two journal entries of goodwill brought in and goodwill not brought in, which I'll show you just now. That is premium for goodwill account debit, and what is the new partner's name? Z's current account debit to X's capital account to Y's capital account. See carefully, 40,000 brought in, 20,000 not brought in, total amount is 60,000, distributed equally in the sacrificing ratio 1:1, therefore 30,000 and 30,000. Those who have actually watched my previous lectures on Goodwill, you might have seen that when the new partner does not bring in Goodwill, his current account is debited and the sacrificing partner's capital account is credited. This is what we have done over here. This is a joint entry or a compound entry which shows you the treatment for Goodwill brought in and Goodwill not brought in. Please see very carefully. Premium for Goodwill is the amount of Goodwill brought in, and Z's current account is the amount of Goodwill not brought in, and the sacrificing ratio was 1:1, which we calculated. So premium for Goodwill 40,000, Z's current account 20,000 to X's capital account 30,000 and Y's capital account 30,000. In this video, I have talked about goodwill which appears in the balance sheet and how will it be treated in case of admission. And by this, we have come to an end of this part of the chapter where we have talked about accumulated reserves which is there in the balance sheet. We have talked about general reserve. We have talked about workmen's compensation reserve / fund. We have talked about investment fluctuation fund / reserve. Generally, it should be investment fluctuation fund and workmen's compensation fund because it is for a specific purpose and it should not be treated as a reserve, but most of the books give that reserve. Don't worry about that. Now, in my next lecture, I'll be coming up with the concepts of revaluation accounts. So keep watching my channel and don't miss any of my lectures.